So we can start.
Yeah.
Sachin is here.
Sachin is here? Okay.
Yeah.
Sachin gave permissions for him. What's the Sachin ID?
SG Divakarana. Good evening.
Yeah, okay, okay, mate. No, మాట్లాడదు SG, Sachin, okay.
Yeah. I'm here.
I think we can start the session now.
1 minute. Okay. GI, Sachin?
SG Anna. Yeah. SG.
Okay. Yes.
Over to you, Deepti.
Okay, thank you.
Yeah, sure.
Okay,
Thank
Deepti,
you.
start. Yeah.
Yeah. Hi, everyone. Good evening, USA, and good morning from India. So myself, I'm Deepti Miryala, Women's Co-Chair from the Charlotte chapter. And thank you, everyone, for joining this webinar, which is organized by Tta Finance team. And Telangana American Telugu Association is the first Telangana organization in North America and a non-profit socio-cultural charitable organization which is built to promote, preserve, and perpetuate the Telangana community in the US. Telangana American Telugu Association is the youngest organization in towns across North America. The organization was formed by a few like-minded people whose leader is Dr. Paila Mallareddy Garu, who is an entrepreneur, a harmonious person, and above all, a good Samaritan, who does not let go an opportunity who are in need. It was launched in 2015. It's a non-profit entity. And my sincere thanks to our founder, Dr. Paila Mallareddy Garu, who created this platform for all the Telangana people in US. And our advisory council chair, Dr. Vijaypal Reddy Garu, and co-chair, Dr. Mohan Reddy Patlola, and advisory council member, Bharat Reddy Madadi Garu, and our president-elect. And let me say about my organization in few words. The mission statement of the Telangana American Telugu Association is Telugu Kalala Tota, Telangana Sevala Kota. Using this as our theme, we are introducing the following strategic initiatives, like foster the Telangana culture for the next generation through hosting and celebrating the Telugu festivals across the US, and protecting our communities in the most vulnerable times by forming a task force and a 1800 emergency hotline. Now, I would like to request our president, dynamic president, Vamshi Reddy Garu from Seattle to convey about this seminar.
No, thank you, Deepti. Thank you very much. First of all, thanks everyone for joining this session. And I would like to thank Divaka Janjam Garu and entire Boston team for pulling J. Devaki Garu with an amazing session on financial market outlook. This is a very good right timing as we did session. Jay Garu, thank you very much, Ani, for coming forward to take this session. Really appreciate it. As Deepti mentioned, yes, the organization is founded by our beloved Paila Mallareddy Garu. And then, we are kind of doing a lot of activities across US. So we have done more than a couple of 100 seminars, which help the community. One other thing I just want to mention is, the very first time the leadership also approved to do a convention in Seattle in May. So please be active to participate in the convention. There are a lot of help needed for the convention, and there's multiple committees in terms of local and non-local committees. You can be part of it. Second is, this is the first time it's happening in Seattle. Please come. Seattle is a beautiful place. That our leadership took a bold decision to try something new. So please come and participate, and we really appreciate if you guys can come and join our convention. And once again, thanks Divakar Garu. Really appreciate you pulling this session together. Deepti, thank you for the intro. Everyone, I don't want to take much time, and thanks Jay Garu. Let's move forward to the session.
Thank you so much, President Garu. Now I invite Dr. Divakar Jandam, Executive Director, and he'll say some few words about the speaker.
And good evening. Thanks for joining the financial webinar. So Jay Devaki is financial guru. And I think probably last 24 hours he didn't sleep. A lot of things going on in the stock market, NVIDIA and stock market, other things. He's busy with a lot of things, but he's very good knowledge fellow. Mr. J. Devaki has more than 20 years of experience, trading experience, and also he helped to manage at least 1 billion project in a portfolio in his prior to engagement, major investment like Barsley. And he left the Barsley, then he started trading. And he did IIT Madras, and then he's also certified financial advisor, and is involved with a lot of financial groups and advising community. And the last few many years, he's helping to the community and being a master interpreter in macro and political geo conditions and also various market. And Jay continuously happens to his skills by academic research and correlation changes and using a learning artificial language intelligence techniques, and his expertise extends to all the nooks of the market, be bonds, commodities, volatility, and equality, emerging and forex. And his expertise in the financial market. And also, Jay Devaki joined by two people, moderators. Mr. Abhiram Parsi is a young student, just finished undergraduation from the North Carolina Business School, and he got a job in financial market New York. He's signing with a financial moderator. And Jagadish Chinna is one of the financial guy. He's expert in knowledge and TTA member. He's also joined the moderator. And thank you very much for Jay for accepting my invitation. Now I would like to give to Dipti. Okay, thank you.
Thank you, Divakar Garu. Thank you for your kind words. Now I'll invite our speaker, Devaki J. Garu, for the webinar. And he's the CEO of JB's Enterprises. He's an IIT Madras grad, and he also has certified financial advisor. And he specializes in stocks, options, risk and wealth management. And yeah, please post your questions in the Zoom chat. Once after the webinar, we have Q&A session. So everyone, please be on mute and please concentrate on the session, and your questions will be answered at the end. Now, Jagar, it's all yours.
Thank you. I really appreciate Divakar Garu and Deepti Garu for your kind words. I do not know I deserve all that you mentioned, but I'll take with that and go forward. I'll try to keep this really simple for everyone. Like, I'm not going into anything complex topics are here. I want to cover like where we are in the economy and what are the likely outcomes for 2024 at a very high level, and how there is two sect of people like investors and traders, like how each of the section of the people can navigate 2024 at very high level. And we can always discuss, and I'm always available for questions and answers. So disclaimers, the standard ones like financial markets come with risk. So please do your own diligence or speak with someone who is qualified before making any investment decisions. I'm not marketing, further disclosures, I'm not marketing my company or anything. And any stocks I discuss or any asset classes I discuss, I might have some positions in there. So my voice might come as biased, but I try to be non-biased as much as possible. And no one is paying me anything, so don't think that I'm trying to market something here. And all views are mine only, 100% mine. And any financial investments come with huge risk. So always consider that before taking your own decisions for your portfolios. The views I express are really like how I view the markets from my lens, and how you could see if there is any value, you could take them, or you could just like, okay, take it as an opinion. So the first thing anybody asks is like, why do I care what happens in the market? If I look at past 50 years or 60 years, markets keep going up. 85% of the time, markets go up. It's a study well published by Harvard University or Stanford, or anybody will say that 85% of the time markets go up, and conservative investing comes from that. So let us say on the beginning of year, like you put $10,000, like 10%, not 10,000, 10% of your gross income in SPY. It's a fund. It's an ETF, and there is comparable ETF with Vanguard, comparable ETFs with the T Rowe price, everything. But SPY itself is very liquid. So if you put your 10% of gross income and forget about the markets, typically you make money over a long period of time, and the average return is around between 10 and 11%. So it is very conservative, no headaches involved, nothing to worry. Typically, over a period of time, like if you put it for your kid, after 30 or 40 years, if you see your account, you keep doing it every year, you'll be making money instead of worrying about every day, oh, market is up, market is down, what should I do now? Like I'm scared, those kind of things. There will be lull periods in the markets, like you can see in the picture, 1999, somewhere, and until 2009, like there is upset, like markets did not do much. But those anomalies like are very rare, but they can still happen. But if you see over a period of time of 30 or 40 years, you'll still come as a winner. This is very conservative investing. You don't have to worry about anything. And SPY is literally the 500 companies of America. So you're literally investing in America. You're not doing anything wrong. You're investing in America growth, and you participate in it. You make money 1 year down, 2 years down, but third year markets come back again. So recessions, inflations, you don't have to worry about all those stuff. That's very conservative investing. That a lot of people ask what is the best way to do. I haven't seen any hedge fund even beating the index funds like that. So it is very, very important for people that have very low risk and just want to do it very safe. Now coming back to our current 2024, where we are, you would hear a lot about inflation and economy and central bank, which is our Federal Reserve. The way we have RBI in India, Reserve Bank of India, we have Federal Reserve here. Federal Reserve has two mandates. One is price stability, which means when the prices go up, they try to control the prices by raising the rates, which will control the borrowing capacity of the people. Like your mortgage will go up when the rates go up, your car payments will go up. So central bank controls that. But they have another mandate, which is to make sure everybody is employed. The economy is running fine with the maximum employment. These are the two mandates that Congress gave to them. And they follow, and they're only answerable to Congress, the central bank. And it was formed in 1920s. And then it got a lot of changes and reforms, but they still follow these two things. People will blame Fed, people will praise Fed, whatever they are doing, but end of the day, they control the economy. So it is very good to know about a central bank. So everybody knows in 2020 to 2023, like we got COVID, there was stimulus from the government, all that stuff, good stuff, which raised the prices on everything we wanted, like people were paying premium on cars, people were paying premium on houses, everybody had money from PPP loans, everything. So the prices went up, and immediately Fed has to jump in and raise the interest rates from zero in March 2022 to almost 5.5% right now. The last rate hike was in July 2023, and Federal Reserve did not increase rates since then. So now you would hear a lot, like since July 2023, the rates were up and economy is humming okay. The job market is doing fine. So people will ask, when are they going to cut? We're going to talk a little bit about that and then jump into the trading and investment scenarios. But the interest rates right now 5.5%, which means the 10-year rate is roughly, as of today, it was 4.28, I believe, which increases your mortgage by 7% roughly. And car loans also will go up as usual. So everybody wants to see, hey, my mortgage is not affordable. I want it to come down a bit. When is it going to happen? So those things we're going to talk a little bit. So like I said, there is two mandates. One is employment and one is price stability, which is inflation. Inflation is on the path to 2%, but it is not there at 2%. That is the biggest issue right now. And the central bank is really worried about getting it back to 2%. But recently Powell is the chairman of Federal Reserve. He said he will not wait for the inflation to come until 2%, but he would rather cut them before. So everybody is wanting or looking for Federal Reserve to cut the rates. Why? Why rate cuts, right? Why do they even need to cut the rates? Some people ask, let it be at 5.5%. Especially the middle class people will take a lot of burden when the interest rates are high. They cannot easily buy a house. A lot of first-time house buyers. Next, they cannot easily buy a car, or small businesses cannot easily get a loan because you're talking about 9% interest, and it's very tough for them to survive because they have to run the business and also pay the interest to the government. Sorry, to the lender, bank, not to the government. But so that is why everyone is looking for interest rates to come down. And it is a teasing thing because inflation is high. Central bank cannot bring the interest rates down. And markets also, it is important because the businesses, the companies you buy stocks, they actually take the debt or loans from the banks, and they cannot repay the debt if the interest rates are high. They go into trouble. So all those scenarios will happen. And eventually, if the rates stay high longer, like they're not coming down, the companies will try to, the companies need to protect their profits. Inflation is coming down, so the costs on the goods cannot be passed on to the customer because there is no inflation. But they need to protect their margins. Like, hey, I'm making, let us say, 25% margin. Now, when there is inflation, I pass on the cost to the customer. Now there is no inflation. I have to make sure like I'm still making my 25% margin. So what do? I immediately cut employees and do cost-cutting measures across the company, like budget cuts. People in IT know there is no maintenance projects that will happen. And enhancements projects or in-house projects will be put on hold. Hiring will be on hold. Then employment will be, companies will start laying off people. All these things businesses do only to protect their margins, which is normal. This is part of their business cycle, though, not to blame them or anything. But if the rates come down, they can actually get the debt easily and they can keep the company running, the business running. So that is the reason everybody is looking for the rate cuts, because the borrowing will come easier. Okay, now looking at the employment situation, like the current unemployment rate is at 3.9%, which means out of all the people that are available for employment, only 3.9% people are unemployed, which is very healthy. The historical average is always like 4.2 or below, and we are like very, very good. So if it crosses 4.2, that is when people raise eyebrows, and Federal Reserve will act faster in cutting the rates, not slower. Because remember, Federal Reserve has two mandates. One is employment, the other one is price stability. Right now, the Federal Reserve is focused on price stability because employment is doing fine. So they're not that much worried. So whenever the Federal Reserve raises rates, this is my favorite chart I typically use. Typically, there is a timeline on the right, and the last pillar that falls is employment. The longer the rates stay high, the companies will let go of people and the employment falls. Initially, the housing falls, and then new orders is basically manufacturing falls, then company profits fall. When company profits fall, companies wants to protect their profits and they try to do they try to let go of people. So that is why employment is always very key part of the equation. Why do we care so much about employment, right? People need to be employed. Why? Because American economy is 2/3 consumer driven. 70% of the American economy is supported by consumer spending. There is a saying which you guys probably know already. When Americans are happy, they spend more. When they're sad, they spend even more. So like the entire American economy is fueled by consumer spending, and they cannot spend if they're not employed. So that employment is really, really the key piece of the whole equation. Okay, so typically the timeline is the rate hikes take at least 24 months for the employment to be affected. So March 2022, they started raising rates, and the last hike was July 23. And if you consider the last hike, we have some more time for the employment to fall. I'm not rooting for it. I'm just giving you the fact for it. So 2024, right? Like right now, markets are running fine. Bond markets and the stock markets are diverging because bond markets are considering a financial issue or some credit issue will come. One issue came in 2023 in terms of Silicon Valley Bank, if you guys remember that, and then immediately Federal Reserve came and rescued the bank. But they said it's an isolated incident. So bond markets are cautious, like there is more incidents that will come if the rates stay higher for longer. But anyway, for now, stock markets and everybody is pricing in. 90% of the people in the economy, economists, forecasters, pundits, markets pundit, everybody is pricing in the best case scenario, which is soft landing, which means no recession, which means employment will be fine, and Federal Reserve can keep the rates higher. Excuse me, and the inflation will come down to 2%. Why is not employment is not cracking up when the rates are higher? Because there is government spending that is happening. They say, I'm not a Democrat or Republican, I'm just saying how it is. There is fiscal spending, which is government spending, which is coming in the terms of Ukraine support. When we say we are giving money to Ukraine, actually we are giving money to our defense budgets, defense people, like defense companies. So there is government jobs that get created as part of that. And then there is Inflation Reduction Act. It is not an Inflation Reduction Act, but it is more spending act. So the government is spending on the one side, stimulating the economy, and Federal Reserve is trying to control this borrowing power of people by raising the rates. So that government spending is still going on. That is why every month, average 60,000 to 70,000 jobs from the government are being created because of the spending. An economy, because of all the liquidity, roughly $6 trillion that was given in 2020 as part of COVID stimulus or whatnot, people multiplied that money. People put it in the stock markets, so money came. Cryptos, money came. Real estate, PPP loans were taken, and then they put it in the real estate, so the money came in multiple ways. An interesting statistic, like before COVID, the household wealth of entire Americans was $103 trillion, $103 trillion. And right now it stands at $156 trillion. So people multiplied their wealth. So their spending never came down. When the spending doesn't come down, the economy can take higher interest rates and keep humming. And even now in some parts of country, if you want to buy something, there is so much competition, like a real estate, for example. People say, oh, I'm buying it because I have money. People are spending like fine, just fine. Whether it could be from their jobs or multiple jobs or the wealth buildup from whatever happened from the COVID stimulus. So soft landing, everybody is pricing and it will happen. But there is another case for recession, just for a review. Interest rates always take effect with a lag. So they take time to go through the economy and impact all the areas. And inflation last mile, this is kind of key. When the inflation was 9%, it dropped down to 4% or even 3% without a problem. It's the same thing as like you're trying to lose some weight. When the first 10 pounds, you would lose really faster. Then the next 5 pounds with some pressure, you will lose. But the last few pounds are so stubborn, you will not lose that weight so easily. The same thing is like inflation. The easy one came down faster. The medium one is what we are seeing it. And then there is a last mile, because Fed says my target is 2%. There is no way. I'm not budging on the target of 2%. Why 2%? That's been there for 50, 60 years. And Fed is not going to change right now because that impacts their credibility if they change right now. So the key thing we apparently need to watch for recession indicators are jobs, and how the consumer spending is and how the growth of the economy is. Right now, there is no issue for any of them. Jobs are good, spending is good, consumer is spending, and growth is really good. Of course, on the consumer spending side, there is a little bit growth in delinquency, like people are not paying their loans on the cars and houses people are paying, but on the cars and credit cards, people are not paying and they're on the rise. They're comparably like in 2008 levels, a little bit below 2008 levels. They are not there yet, but there is some delinquency rise. Jobs are fine. And people always have conspiracy theories about jobs because government is fudging the numbers, those kind of things. But right now, there is no red flags in terms of recession. But as economic forecasters or economists, our main job is to see like what everybody is missing. What are the blind spots? What are we missing? Like if it is so easy, what are we missing? Like are we ready for some kind of risk? So we have our own models. So our model, the recession model, we take all the economic data that comes every month and also forecast based on mathematical models and everything. And we see like still see it's too early. Could be model, could be wrong too. But with certain level of confidence, we can say 83% as of 2024, February 15, the last line, and with 83% probability that the recession would have started on December 24, or if you take the -1 standard deviation and +1 standard deviation on both sides, on 215 or 11.1, but don't pay too much attention to the dates. But our model thinks like there is some level of possibility, which is 83%. Again, the model could be wrong, right? Because the economy is running fine. Nobody knows for sure, but we have to do forecasting, so we do that. 83% probability the recession is possible this year. Again, like investing people, it is very easy.
I've asked people about your genius.
I'm not sure if you can listen to this.
No, I'm a bright guy.
Yeah, we can hear it.
Yes, and Jagan.
It's only like 90 seconds, not even lesser. I encourage you to watch.
Yeah, can you pause it and replay, Andy?
Yeah.
But bring out the best in me. About your genius, whatever you describe it. No, I'm a bright guy who's terribly interested in what he does. So I've spent a lifetime doing it. I've surrounded myself with people that bring out the best in me. And you don't need to be a genius in what I do. That's the good thing about it. If I went into physics or a whole lot of other subjects, I'd be an also ran. But I am in a game that you don't need. You probably need 120 points of IQ, yeah. But 170 doesn't do any better than 120. It may do worse, probably do worse, but you don't really need brains. What do you need? You need the right orientation. 90% of the people, I'm putting a figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week. And they think about the market as something they hope goes up. And if it's down, they feel worse. I feel better. And you think about? Pardon? And what do you think? I think about what the company's going to be worth 10 or 20 years from now. And I hope it goes down when I buy it because I'll buy more.
Well, that's it. Like it's a very simple but very powerful video. How short term we think versus, especially I'm talking investing. I know traders don't care about this, but investors will say, yeah, long term I'm thinking, or the wealth I'm building, I want the stock price to go down more. And if the business is good, I'm gonna buy it and keep buying it. That's what he says. And he says you just need to have right orientation and not really worry about every day what happens with the stock prices. So nothing like you want your stock to, the company you're looking at, the stock price you're looking at to fall more. So you'll keep buying it. That's what he keeps saying. And if there is a chance, he would want to own 100% of every company. Of course, we all do, but that's not possible. And invest for long term. And he doesn't hedge or anything like that. This investment, if you don't like the business, then sell it out and get out. If you like the business, just keep holding it. Because eventually the stock price will catch up with the business, because business is doing good. Anyway, that's for investing. I know there is another sect of people who look for active trading or active management. Because that is where like you can beat the investment returns by doing active trading. Some people will have passive income, secondary income, whatnot. So people do multiple ways, like using technical analysis, and then they follow the price action and multiple technical indicators there are there to follow. The people follow all those things and then they do it. That is for traders though. And they also look at the fundamental analysis, they do the technical analysis, combination of both, and they can do. I'm just gonna go through like sample allocations, like when things change, when there is like on the car, first gear, second gear, third gear, you will have different gears and different regimes or different times in the financial markets. When inflation is rising, of course, we are not there right now, but I just put it out there. Right now, markets are looking is really the growth regime. So, like the technology stocks are going up, currency is okay, precious metals, they don't perform. Crypto will do better. Riskier assets is like people take more risk when there is growth and when there is liquidity. But when the recession comes in, like you can change your portfolio allocations to differently. Like you can change like short commodities, short dollar, and people in recession regimes, people always need their toothbrush, cereal, or whatnot. So you are going to go long on staple stocks, healthcare stocks, because you need healthcare insurance and you need power, those kind of things. Those will always perform better. And luxury items, discretionary items don't perform, like durables in the sense washing machines. People will postpone them in the recession times. Oh, I don't need the washing machine right now, or I don't need to make home improvements. I don't need to buy a new car. I would rather fix my existing car and do it. So those things will be, when I say short, like they don't perform better, so you short those stocks. And of course, people want safe havens, so the bonds will perform better. So like depending on the regime, you can always shift your allocations of your portfolio and try to make the best out of it. This is for active people. Again, I showed you the Warren Buffett method, which is very simple, very straightforward. He doesn't care about inflation, recession, or nothing. He just holds the companies, because his best companies always perform better, even when the situations are not favorable. But for some people who wanted to actively manage, like on a day-to-day basis, they can do this. Again, like I said, I gave the things across asset classes because I know some people want to do commodities, some people want to do stocks, some people want to do only bonds. There is multiple people who wants to do multiple ways, but it is all one big trade. For example, I do everything. I just don't stop at stocks only, but the people I interact with, they always want to know about the stocks, right? The stocks is very easy to correlate with and easy to trade, easy to get associated. But for me, if I go long bonds and short stocks, again, it is one trade only. But my point is to maximize the same trade, you can do it in multiple asset classes. End of the day, it is all one trade only. But again, there is no force to do all the asset classes. You could do whatever works for you. But that's my livelihood, so I go for everything. These are the sample ones again. Within the discretionary, like, there is ETFs. You don't have to do the stock based. You can do the ETFs. For example, utilities was XLU ETF, which is very popular. Healthcare is XLV. Those kind of ETFs also you can be there, or do individual stocks, take the top stock and then go for it. Like, for example, Staples has Procter & Gamble, which is a very top stock. So it works really good when during recession. And McDonald's or even Walmart, those things really work better. I mean, there is like tons of ways you can skin the cat, but I was just giving you some high level ways to prepare yourself and your portfolios if you are actively managing, or if you are talking to a financial advisor. You can even ask him, hey, what about this? What about that? Then they will give you ideas. Oh yeah, I'm going to do it. If you don't ask your financial advisor, they're not going to tell you anything, and they're not going to change the allocations. But again, this is like for active people. And that's my contact information, but I would leave it for any questions and answers if you have. And then we'll wind up. Take a few questions and we'll wind up.
Thank you, Jay. Thank you, Jay. Very informative session. Now I would like to request Abhishek Patrik. Is a graduate student. Is joining first time in the webinar as a moderator, and followed by Jagadish Chinnam. And Jagadish, Abhishek, you can take a questions from the Zoom chat and other questions also. Thank you. Thank you, Jay. Okay.
No worries. Thank you.
So
Yeah.
Jay, I have a question for you. So
Yeah.
today is a big fever everywhere talking about NVIDIA. Everybody focusing on NVIDIA stock, market, AI. So what is the future of the AI and particularly, chip stocks,
Yeah, absolutely. That's a good question. Very relevant for a day-to-day thing. AI, I believe, like everybody, is real. It is real. I have seen some applications myself, and right now it is really at the very hyperscaler level, which is like huge companies like Meta, Facebook, Amazon, Apple. Those are the companies that are embracing. It needs to come back to the enterprise level where small and medium companies will take it. And I know ServiceNow, to some level, Snowflake, these companies are also embracing AI, and literally every company will embrace AI. It is supposed to make our jobs and lives easier, increase the productivity. When the productivity is increased, the labor force, even if the output will be better when the productivity is improved. Even with even people will be, different skill set will come into picture when people need to be employed. But the only concern, everything is real, and NVIDIA is doing great. I listened to the call this evening, and I do not see the growth stopping for another 2 to 3 years minimum. So it is all looking good. My only concern is like we are pulling forward everything so fast, so soon, like so fast, like the price of like, for example, NVIDIA itself, right, jumped in 50%. Since January, less than 2 months, it jumped 50%. I'm not saying it's a bad thing, but it's like sometimes markets can get irrational, but that doesn't mean like there is value in it. I mean, NVIDIA has value, but everybody wants to catch the train, so they're getting faster there. Ideally, I would not jump on the bandwagon and wait for pullbacks or anything to investing. But trading, yeah, why not jump on the bandwagon and make money? So you got to put a different hat and do it. SMCI, same thing, like a very small company. Like these are what I call mini bubbles that will form, and when they burst, like people that bought at highs get stuck, and they get upset because they paid high price for it. So always be cognizant where what price you are investing, how much growth is left, those kind of things when you're doing, especially the AI. AI is the new mini bubble. I'm not saying it's so much real, but the faster it is happening, the careful we need to be, because they pop.
Okay. Thank you, Jay. So
Yeah.
Abhishek, you can start the question answer Q&A session. Okay. Yeah.
Yeah. Thank you, Divakar Garu, and thank you, Jay, for the nice presentation. I just graduated from UNC, from the Keenan Flagler Business School, and I'm starting a career in investment banking in New York this summer. So it was nice to kind of hear your presentation about this, and it had a lot of great information. So thanks for that. But just, I guess, to start out with some of the questions, we'll start from VK's question. How do you fine tune or plan your portfolio considering majority of the countries going through sovereign debt crisis?
It's very, very good question. Very important. Um, let's talk about US debt itself is right, 34 trillion. It is not a problem until it is. That's how markets look at it. I'm not blaming one political party or any other thing. And eventually, I don't know when, nobody knows when, eventually there will be a reset. I don't know when. And I'm expecting it to be soon, sooner than later. And that is why, like I was talking about a little bit of the bubble also. The debt is a huge bubble that can pop anytime, and people will be there for a rude awakening. But how you position itself, like we'll get some indications, like bond markets will get crazy, of course. You have seen in, I believe, October 2023, 10-year went up to 5%. That is when like Ellen came back and said, okay, we're not going to issue so much issue so much coupons. We're going to do so much bills and you'll be fine. That's what she did. Like markets, especially bond markets. When I say bond markets, don't look at US market, whether it can be gilts of UK, 10-year bonds in UK are called gilts and Germany are called bonds. Wherever you go, but everything is very, very highly interlinked. Emerging markets, developer markets, or developing markets, everything of bonds are interlinked. And bond markets are very good at sensing when the debt is getting out of hand. And they typically send messages to government by selling off very harshly. What happened in October, and the interest rates jump, and when the interest rates jump to 5%, even Ellen cannot, even our US Treasury, I'm saying Ellen, but US Treasury cannot service the debt. So they will be in a pickle, and that spirals the debt again. So I think governments know what is going to happen if it keeps spiraling out of hand. Right now, $35 trillion, and it is raising $1 trillion by every year. It's not sustainable in long term. So we should be ready for that rude awakening. Very good question. We should be ready for that. I just don't know when. It is not a problem until it is.
Thanks.
But you would
Thanks.
not miss it. The message will be loud, message will be clear. We will not miss it. Bond markets will send a huge message at the time.
Thanks, Jay Garu, and thanks for a wonderful presentation. I attended several presentations, but such a very clean and very simple to understand in a layman people. Thanks again. And the next question is from Uday. What are some of the best equities or ETFs to invest if I have a cash on the sidelines right now as market is top? Because cash is right now yielding a little more than 5% right now. Can we still keep holding cash in treasuries and CDs, etc.?
Depending like absolutely for 2 years, like 1 year. But after that, I believe like the cash will yield less. So for short term, we can still hold cash, which is very, very risk free. And T-bills, treasury bills will give you like 6 months notes or 3 months notes or even 1 month note, which you can buy it on a recurring reinvestment way. They yield you more than 5.3 or 5.5%. But the time comes where like the cash will not. Sorry. Yeah, but a time comes where the cash will not be helpful for you.
Sorry, Deepti, you muted Jagar also.
Sorry, Jay.
Yeah, the speaker is on mute.
Please unmute yourself. Yeah, let's.
No, it's going in a loop.
You're good. You're good now.
Okay. Can you hear me?
Yes, we can.
Yeah, the cash is good now for at least a year, I was saying. And if it is a conservative investing, I'll go through the index funds. Again, you don't have to be like obligated to do SPY, but I think that is the best way to go, like investing with less risk and less headache. You don't have to worry about anything, and it keeps going. Depending on your risk level, if you are higher risk level, I'm not saying now, but when the markets sell off, you could go into technology stocks where nothing will be permanent. But when the markets bounce, technology stocks bounce a lot. And you guys would have seen um, Mag 7, people call them Mag 7, Magnificent Seven, except now they're calling Super Six. They took out Tesla out of the list, but regardless, you could allocate to them, like dollar cost average in them. I know people may not like the idea, some people, but in my view, without those stocks, the markets are not going to go anywhere. Without Apple, without Amazon, without Google, markets not going to go anywhere. And when they fall, markets will fall, but they come back very fast and markets will be fine again. So that is another thing to consider. If there is a little bit of risk to tolerance to volatility. If you can handle volatility better, they are better. If not, simply SPY like index funds are really good to yield you money. But for now, like at least for the next 1 year, starting now, you still have good returns in the bonds. T-bills, 6 months, 3 months, 2 months, one month or 13-week notes, you can get better returns in them.
We should go for it.
Yeah, cool. So one more question, I guess, is PT asked, I guess, as like a general question, if you could explain the difference between trading and investing.
Right. Investing is where you buy a quality business for a fair price, decent price, and hold on to the business. You're buying the equity in the business. Of course, nobody can buy a whole business, but you're buying some equity in the business and you're holding on to it. In over a period of time, your equity multiplies. Like if a company buys back their stock and issues dividends, your investment gets compounded as well. Like Apple, for example, they issue dividend, they also buy back the stock. Recently, Meta is doing the same. So they issue dividends and they also buy back the stock. What happens when you get the dividend? You can take the dividend and buy more of the same stock, same company. So that is how your money is compounded investing. Trading is like generating income on the other side, uh, timing the market to some level based on like technical indicators or fundamental analysis or earnings results, those kind of things. Timing the stock price movement and trying to generate income in the short term and making money. Both are very different. One can do both. I believe investors are very capable to do trading, but traders are not that capable to do investing because their emotions are very short-lived and they cannot have short, long-term thinking. So depending on what is your risk tolerance, where you are in the life, what is your financial goals, and all these factors considering, you can do both or you can choose one. Everything like some people want to do trading and they try and they lose money. Like 90% of the people lose money in trading. I'm not like magnifying it or anything. They lose money because it's not easy. Once they lose money, they say, oh, it's gambling and it's we are not doing it, and they move away. They would become the investors. So like it's always better to figure out what is our goals, what is our risk levels, and those kind of things, where we are in the life, and take the path we want to take. You can do both, but again, like it is an extra responsibility. You got to stay on top of what you're doing. So that is with the trading. Investing is more like you analyze the business and then invest in it and forget about it. Of course, when the story changes, you would not miss it. So, for example, if you invested in Apple and suddenly America says, oh, we are banned. I'm not saying it's going to happen. Or China says, like, we're banning all iPhones, there's 20% of business is gone. So then you should be worried. So you need to be updated of those things. But in general, the story will be fine if you invest in good business in companies.
Okay. Thanks, Andy.
Yeah.
I'll go with mix with a couple of questions because there is a lot of questions. So the first question is, when do you think the different industries will recover from their lack of hiring in the tech, investment banking, private equity, etc.? And another,
Yeah, go ahead.
yeah, quick question is probably you can add there recommendations for ETF that have low fee and offer better conservative returns if you want to follow Warren Buffett method. Please provide top 5 picks.
Yeah, top 5, like, okay, let's go with the first one. Different sectors wise, like private equity, they're struggling right now because of higher interest rates. You would have seen there is no IPOs coming into the market as much. Back in the day, you get an IPO every day in 2020. Every company wants to come into raise the funds in the markets, public offering, and grow. Now the growth is slowing down, and companies are not. Nobody's opening their checkbooks and writing checks, especially private equity. When the interest rates come down, they get back again. Like the normal interest rate is, let us say, 2.5%, which is 3% less than the current interest rate. Then they'll be okay. Then you can see some level of activity picking up. Their hiring going up. They try to expand their business operations, those kind of things. The second question is like about the ETFs, where the less expense fee, all those things. Literally, like if you're doing passive investing, like I was talking about SPY or VIVO, like Vanguard ETFs, I won't be worried so much about their management fee, like very, very less. You would benefit more than actually you're paying any fee to them. I wouldn't be worried as much on them for passive investing.
And the top 5 and any recommendations?
Like I just mentioned, SPY, VIVO, I can give them on the site to Divakar and he can pass on.
Sure, we'll do that one. Thank you.
Yeah.
Yeah.
Abhishek, go ahead. Abhishek, go ahead.
Yeah. So Chandra also asked me, just looking at kind of NVIDIA right now, what are some trading methods that would be ideal or most probable to make money? Just I guess with respect to like NVIDIA and this like tech boom.
Yeah. So I'm not supposed to say answer that again. So it depends again, right? Like personal goals and what is your risk level. That is very, very important. Knowing one's risk level is very important. I know people that has high risk tolerance and they play derivatives like options, which are leveraged, and they play derivatives. And I know very low risk people that only play stocks, like buy stock and hold on to it. Even for trading, like swing trading, hold on for a few days to ride the momentum and then come out of it. Again, it depends from person to person. I do options. Everybody knows probably. I do derivatives. I don't have problem with them. But derivatives come with extremely high risk. You need to know when to get out of them, when to get in. Always swallow the ego. I call that swallow our ego. Sometimes we are wrong, and sometimes take the loss and move on. Instead of thinking about it every morning, every night, take the loss and move on. So derivatives come with a lot of mental baggage. So you got to be ready for that. The other ones are pretty straightforward. So know what works for you. Practice a little bit on the paper, which when you practice on the paper, you don't have emotions. So you always make money. But when you put your real money, then there is emotions will come in. So it's a process. It takes time. There is no secret like I can put money and become overnight rich. It happened in 2020 with the Tesla, those kind of things. But right now, occasional dislocations are there in the markets like SMCI or NVIDIA, where they were running crazy. But then they came back again, and you don't want to be the person like left with the bag in the top. So be very careful is what I would say when you're doing the trading. Again, know the risk level. If you're younger, you can take some risk. Yeah, take it. You will learn lessons. But if you're not younger, you're in 50s or 60s, you don't want to go put your retirement money in there and then feel bad because the stock doesn't go up after you took it. Because by the time you took it, which means that is probably the top. Because the knowledge, like you should be able to predict it before it happens. So once you took it, it could be the top, and you got sucked in. So we don't want to be in that scenario. So it's like very fine two-edged sword. You got to be really careful when doing the trading. especially the derivatives.
Yeah, thanks, Andy. We have a different question because we talked a little bit more on the stocks. What is the future of cryptocurrency, and when is a good time to buy or sell these?
Okay, he probably asked the wrong person. I hate crypto. I don't believe in it. I know young people will hate me for saying that. I don't believe in it. The crypto is as good as you have the next buyer. If you do not have the next buyer, your crypto is useless. That's how I look at it. I do not have use cases for them. Like Apple phone, if you give me, I know what to do with it. Or if you tell me Amazon, I'm going to go order some items and bring them. Crypto is purely like speculative, gambling kind of category. You don't have a buyer, your cryptos are useless. So that is where I'm kind of conflicted. That doesn't mean I don't trade. I trade sometimes Bitcoin, related stocks, those kind of things. But I think Bitcoin and Ethereum are the only two things that can stay. I could be wrong. I'm old school, so like they can stay, and maybe there should be more regulations that come. And even like we cannot get anything regulated in America, and this is like a global phenomenon, crypto. I do not know, but there is a long way to go. There is definitely more users that might come later, but right now, like they're like for me useless. I don't know what to do if you give me all the crypto.
It's an invisible currency, right?
Yes, it's invisible, nothing tangible. Well, you make money though. That is real. Their bank account again. It's funny thing. You make real dollar bills, but it is still crypto. It makes you dollars. So it's a good way. Like people look at like I said, it's as good as if you have the next buyer, you're fine. But when the buying stops, that's when your crypto music stops. It doesn't. It doesn't right now because as long as there is buyers, it's fine. I do not personally support, but if you want to have some in your portfolio, I have some too. I have Bitcoin and Ethereum, both I have in my portfolio. I got them because this is what I call managing the tail risk. Tail is like you guys know the bell curve, right? Bell curve has a right tail and there is a left tail, and then there is a middle bell portion. When other assets are not performing good, cryptos perform. So my portfolio is happy because I'm making money. I'm good only in that aspect. So I have some exposure to crypto, but I'm not putting my entire portfolio in crypto. Maybe like less than 5% of my portfolio has crypto exposure. I'm happy with that. And it gives me sometimes great returns. So I'm like, even if I'm not making money on other things, if I'm making money on this, I'm happy. And I only have Bitcoin and Ethereum. But in the core, deep down, I don't see any value for any of them. But that doesn't stop me from buying them. Hope you don't judge me from that.
Yeah, how about the Dogecoin? Is it any
Again, I said like I don't know what to do with Dogecoin or anything. Junk, speculative, 100% gambling.
Please post your questions in the chat window. Yeah, thank you.
Yeah. And also, since index funds such as like SPY and QQQ are at their 52-week highs right now, is there still room to invest in them, like investing into them right now?
If you're doing passive investing, typically people enter on January 1st or September 30th. September 30th, I always have a reason because markets always fall in September. So people will get a better entry. And January 1st, people will get new money. So they'll always put in those 2 dates. Like new money and sell off. When everybody is selling, you go and buy, which is a very old rule and very good to follow. So even between now and the elections, like in September, if you get a good sell off, that's when I would invest. I would not rush to do right now. Because if it is your first time, then you can follow a set date, either January or September end.
Thank you. What are your top 5 favorite long-term investing stocks?
Oh, Mag 7. I know everybody hates them, but I love them. I don't know. Even when they go down using derivatives, you can make money. or Tamanna, you can call Tamanna. I know that's a very popular name back in the day, like when you have Netflix also in there. Um, I love them. That's it. I won't even think twice. Of course, I will diversify with JP Morgan Chase, like from banking sector. If I want from another sector, I'll go for for example, Caterpillar if I want industrials, like I pick the top names, or UNH if I want healthcare, like to diversify a little bit. But my risk tolerance is high. Even when they go down, you can make money because so I just follow those stocks. If markets cannot go up without them, they cannot go down without them either. So I'm always in them.
Jay, I have a question for you.
Yes, sir.
Right now, the markets are okay, only few stocks.
Yep.
Jobs, no more jobs. No big companies are hiring.
Mhm.
They're making profits. And Fed is not cutting down the interest rates.
Mhm.
And mortgage rates are going up. So what's going to impact? The Fed government is saying, oh, economy is doing well, inflation is down, no jobs, real estate 7%.
Mhm.
What's going to be happening in the market? And the current president is not doing much. And I don't know what's going to happen next government, So
Yeah. So the debt crisis, right? Someone else asked the question about debt. The government debt is ballooning, like it is not stopping.
yes.
Yeah, you raised a very good point, sir. Those are the things that will impact the second case here, recession. Um, I'm not blaming Fed. I have no qualification to blame because they are like the top economists in the world. They have thousands of staffers that are continuously feed them information. My exposure is very limited. I cannot blame them or I cannot judge them or anything. But one thing I noticed is like they're looking into, I mean, Powell's meetings, every time you listen to him, he keeps saying data dependent. We are data dependent. We are data dependent. Nobody missed that. So you're literally looking in the rear view mirror, sorry, in the back and trying to drive in the front. Fed should be in a place where they can forecast better than anybody else in the economy, which is not happening and which is what concerning me. And that is where I feel like I know people will say only top 7 stocks are performing, others are not performing. Absolutely. That is another issue because the breadth is not there, breadth of the markets are not there. These are real issues. I'm not saying they're not. Again, they become a problem when they become, it is a problem when it is. Right now, they are not. So everybody is happy singing the soft landing song. But when they become the problem, things will change so faster. Jobs, the, the main reason jobs are not like falling a lot, um, like companies do have some level of cushions and they're doing manual job hoarding. They're not cutting people so easily because they saw what happened in 2020 when they let people go. They do not have they could not hire people immediately back. And the key areas where the jobs are holding really, really good are healthcare, like medical services. People need to go to hospitals. There is a requirement for registered nurses, other service people in the medical industry, like old age home caretakers, those kind of things. That is one area. The second area is travel, and the third area is hospitality, which is bars and restaurants. Again, I was telling the household wealth from 103 trillion to 156 trillion. The baby boomers who got retired are they don't want to work after COVID. They are spending on money on experiences. They're traveling. They're going to restaurants and eating. When the people eat like that, because their household wealth is improved, like multiplied. Back in the day, it doesn't go like that crazy. It went really great for them. And so they're saying, okay, I'm done. I'm going to go eat and enjoy my life a little bit or travel a little bit. Those industries are still hiring because there is demand for them. So we always look at IT people. Oh, Dell is firing people. Apple is firing, or even like ServiceNow is firing. The first impact always comes to IT. But and we also are very inclined to IT. They say like, oh, like IT jobs are going down, so we are really in a bad position. But no, The other jobs are fine. Government is creating infrastructure jobs, defense jobs, medical services jobs, travel jobs, bar and restaurant waiters. Those people are literally, they're hiring every day because people have so much money to spend and they're still spending. That is the downside of it. So until we see those industries impacted, we do not see jobs going down. Hope that makes sense. But the debt is a looming problem. The debt crisis is really real. I don't know when it happens, but it will be like a rude awakening for everybody when it happens.
Yeah, because government is spending free money to everywhere,
Yeah,
So,
it is. Yeah, it is taking money from the future of our kids, grandkids, grandkids, and spending right now. That is crazy. Like between Trump and Biden, both of them increased the deficit, the budget deficit to 21%. Before Trump, I'm not blaming one party. Before Trump, it was 2%. Now it is 21. Of course, COVID happened. Nobody says anything about it. But we are not, even Democrats are spending like drunken sailors. I don't think Trump comes, he's not going to stop spending. That will keep on going. And we are not raising taxes anyway. I mean, we'll go into a different topic, but our personal opinions or anything, like I see how it is. We are taking money from future and spending right now.
Okay, thanks, Andy. Another question from Sunita Garu. Since the return on T-bill is good now, can we lock this rate for many years, such as 5 years?
No, T-bills are only like very short period. They are 3 months, 6 months, or 1 year maximum. Then you have 2 year bonds and then 5 year bonds. They do not offer the same rate. You cannot lock them basically. So it's only for a year maximum.
okay, next up, Sheikh. Yeah.
Yeah.
So, yeah, there's another crypto question, but yeah, so the Fed says inflation is coming down, but on a day-to-day basis, price didn't come down yet on goods. On the other hand, companies do layoffs and geopolitical wars. How would that impact? Yeah, we've answered this, but one is, what is your view on the market for the next 2 to 3 months? Just
Next
high.
2 to 3 months. I'm in the camp. We expect a small correction and then we take off again. Like the correction in the sense between 5 and 7%. Something I'm looking for, and then we go up again for the next 2 to 3 months.
Okay. And I guess could you elaborate on like the previous on like T-bills, T-notes, and like just longer US Treasuries as well? Not just like the under a year.
Yeah, no worries. Like T-bills are like T-bills, notes, everything are US government debt. The government is asking you to buy their debt because they're, in other words, you're loaning the money to the government. Let's put it that way.
Yeah.
It's very easy. You are loaning the money to the government for a short period of time, and the government is paying the interest back to you. So American government debt is as good as cash. So you can give money to the American government, which is US Treasury Department, and the Treasury Department will give you the interest of 5.3% or 5.5%, those kind of money. For short-term maturity debt, like 3 months, 6 months, 1 year, they're called bills or notes. Basically, it's a promissory note. You guys know what is a promissory note. But if you cross like 2 years, they're called bonds. Bonds will come with coupon. Coupon payment is basically government will give a payment semi-annual. For a 2 year bond, they'll send you like the interest every 6 months. The bonds come in multiple tenures, 2 years, 5 years, 7 years, 10 years, 20 years. The longest one is 30 years. So all these are government debt. It's basically government is taking your money and paying you interest. Very risk-free. US government did not bankrupt by far, but it did not happen. So knock on the wood, it won't happen. But that is the overview on bonds. Guys, can you give me 1 minute? I need to take a nature break.
problem. Take Jay. Thank you. Yeah.
Diwakar Garu, while we are waiting, do you want to talk about the convention or any other?
Yeah, already President talked about. President Vamshi, he joined before webinar. He talked about.
Yeah, he's already. Yeah,
he
so
did that
it's
one.
fine.
He did that one. Yeah. So I think there are 2-3 questions are there, so we can finish up the questions. Then after that, vote of thanks. Okay.
Sounds good.
Thank you. If any questions, you can ask Abhishek and Jagadish and other participants. Yeah. Because nowadays only the 7-6 stock markets are going up and down, but not other stocks. There's not much improvement in real estate, interest rates, and other things. Yeah.
Yeah, correct అండి దివాకర్ గారు. All the AI magic.
Yeah, AI magic only pushing some stocks, and
Yeah.
people are happy with the big stocks. All the newspapers, they're focusing only those stocks only. But a lot of other stocks are there. They're not doing much progress. Yeah. So like Microsoft, AI is not only the world. A lot of other things are required for our living things. Yeah.
Yeah, at least we need to learn this technology to be at the same level in the next few years.
Yeah. Exactly.
Jagadish, Abhishek, you are doing a good job.
Thank you, Abhishek. Thank you, Jagadish. Yeah. Abhishek is just finished college.
Yeah.
And he got a job in New York. Okay, thank you.
Oh,
Thank
nice.
you. Yeah.
Yeah. Jagar is back, and thank you.
Yeah, I'm back. Thanks, guys. I've been drinking water nonstop.
No, that's, yeah. We have just another 2 questions, and then we can, or 2 or 3 questions.
Okay.
I know you already addressed, but people want to know that when you say that market correction, it is going to be in the March, or when is the question.
I'm hoping for one in March.
Okay.
That said, if it doesn't come, that's happy, right? But here is the thing. Everybody is saying since October market is running, we need a correction. And everybody is looking for it. It doesn't come. When no one expects it, it comes. So that's how it works. I'm sure expecting something in March, because March has this quarterly options expiration window. And typically, markets, if they're running ahead, they'll correct during March. Same thing in June, those kind of things, September. That is why September also we get corrections. Let's see if it comes or not, but that's what I'm looking for.
Fingers crossed. Yeah.
Yeah.
Yeah. Can you please talk about on the hedging, and people want to know a little bit on that.
It's a topic by itself. It's a huge topic, but I know, like, I had some webinars in other community groups, but not here. I think it's a big topic by itself. It cannot simply cover in like a question. Its hedging is basically buying insurance for your portfolio. Depending on how your portfolio is weighed, if the technology stocks are diversified, you can follow various strategies, not just one. Yeah, I would like to cover, but it is not in this. It's out of the scope for this, I believe. Maybe next one we can see.
Jay garu, oka question andi. When is the time to convert bonds into stocks? Okay, some of my, some of the portfolios in bonds, like.
No, sir. I mean, like, I would say keep allocating to bonds. Never move that money, kind of. If you're talking about 401k, it's retirement for that reason. 60-40 or 80-20 allocations. Bond market is a behemoth, and stock market is like an ant. Like if you call bond market as an elephant, this will be like an ant in front. Stock market is an ant. bonds will protect you during recessions, but they will not protect you during inflations. But during recession, bonds will protect you a lot. I would definitely, if it is your biggest portfolio, I'll always allocate some portion to bonds. Never get under allocated to that. Only then when like it's changing the dials, like how you allocate. During recessions, you increase the allocation to bonds. And when the recession is passed away, our government is giving again stimulating the economy, central bank or government, then you actually again change the allocation, more allocation to stocks. But bonds should always be there in the portfolio. They will protect you from unforeseen situations, like when there is a war, bonds will help you. Like uncertainty, bonds will help you. So it's always fine to have some level of exposure.
Thank you, sir. Thank you, Andy.
Yeah.
Jay, I have a question for you.
Sure, sir.
So recently, Warren Buffett, he dumped all the Apple stock. Then he bought Chevron stock. What's the strategy? He made a lot of money in Apple stock last few years,
Yeah. So I'll give you some background on that, sir. I follow that very closely, especially Buffett and his allocations. 2016, I believe he started buying Apple stock. And for 2 years, he patiently waited. He did not buy all at once. He bought the Apple stock over a period of 2 years for his portfolio allocation of 5%. Right? He has that. He only put 5% in Apple. He did not. Now, by 2018, he is done. He did not buy any more Apple. Now, what happened since was like Apple exploded, and it took almost 45 to 50% of his portfolio. His 5% became 45 to 50%. Now, recently, what he did was only selling like less than 10% of his portfolio of Apple. He did not sell everything. So he still has major stake in Apple. He will not sell Apple until there is Apple is giving dividends and Apple is buying back their shares. He's not going to sell it. He loves Tim Cook. But again, when one position becomes too big in your portfolio, even I would sell too. Like everybody sells it. And a lot of fund managers, they sell if it becomes 10%, they get nervous and sell, because it is called concentration risk or single stock risk, you can call it. One stock is impacting your entire portfolio. You just want to minimize the risk by selling some. And I believe he did the same thing. And he still has Apple, tons of Apple. Like I wouldn't be worried about it. And he got dividends and he reinvested in Apple again.
Thank you.
Yeah, there are some questions and a quick one. Somebody is very new to the trading and all. What is the best way to start learning? And
the best way is, there is a couple of books, sir. Like recently, I read also the Tao of Trading, the TAO of Trading. You can buy it on Amazon. There is an ebook. You can start with that. Again, like for novice people, like do not jump into derivatives, but try to see like follow a set of rules to trade and make money, but not get carried away with what is happening around, what your friend is doing, what somebody is doing, because they are not the same. Your situation is very unique. Your family is unique. Your parents are unique. Your kids are unique. Your financial goals are unique. You cannot match with your friend and compare with your friend. And Indians, I'm part of that too. We always try to compare with our friends and, oh, that guy is making, I should make money too. That comparison will set you downfall right away. So be the hero of your own movie. Start slow and then learn those techniques and then do it slowly. That's what I would say.
Yeah, that's a good one, Andy. Yeah, so my suggestion is just buy small stocks, like one stock of each, like 20, 30 stocks, like that. Then it won't be much loss, even if it is loss. But you will learn in the process over the two to 3 months. You will learn how the stocks make. Then you can increase your portfolio accordingly. Buy one stock, two stock, three stocks, based on its value.
Yeah, and stay away from junk stocks. People will give recommendations on telegrams, WhatsApps, all the junk. Stay with the good ones like Mag 7. Uh, Even if you lose, fine, you'll make it next time. Because those stocks nobody can manipulate. People always give like penny stocks. Oh, this penny stock is gonna make you 10,000%. You'll lose eventually, all those penny stocks. They won't have liquidity, you will be bag holder and money is gone.
Yeah, how about the REITs, Andy? So some of portfolios in REITs, they are in the means they're the good dividend ones, but the principal wise, it's 50% loss, something.
Yeah, the dividend doesn't help when the stock is going down. The REITs are in trouble right now because the small banks, they have concentrated risk on commercial real estate loans. So like there is properties that are going vacant because the hybrid work model came after COVID, like, and it came with a full swing. A lot of office buildings in New York are also being converted into apartments. So there is some level of stress, not too much, but level of stress in commercial real estate. So that is the reason REITs are taking heat right now. When the interest rates come down, they'll come back up. Until then, the heat will not go away. And there is concentrated risk, especially in small and regional banks, because they give loans to commercial buildings. And when the time comes for the loan maturity, now the loan needs to be refinanced at a higher interest rate. In 2020, they took probably at 3% or 2%. I'm exaggerating, not 3%. It's a business loan, at least 4 or 5%. Now we are talking 11%. And multifamilies, people we are hearing in Dallas, everywhere, they are going bankrupt because their net triple net is only probably 5 or 6%. Back in the day, like they can handle them. Now their interest is 11% and they're making 5%. They cannot handle, so they let them go to bankruptcy or foreclosures, those kind of things.
Yeah, a very quick question, Sandy. What is the percentage of the portfolio should we invest in bonds, and what kind of bonds or bond ETFs need to be considered?
Typical, if you're talking about retirement thing, like 60-40 is very normally followed, 60% bonds and 40% stocks. And some do 80-20 also. As your age goes up, people go for 80-20. Every fund that your retirement custodian, 401k custodian offers is okay. But for individual portfolios, you can change the dials or move the allocations based on the risk level. Individual portfolios, I'm talking. I mean, individual portfolios, you may not need to have fixed income. If you have them in the 401ks and IRS, if you have them, there is no point in carrying bonds again in the regular trading portfolio or stock portfolios. But if whatever you have from your custodians are normally fine, I would not touch the retirement money at all because it's called retirement for a reason, right? It's supposed to help you during retirement. It's supposed to be entirely passive, and it's supposed to be coming with less pain for you. If you keep changing allocations in there, and one wrong step will set you back in your retirement funds, and nobody wants that.
What are your top 5 tickers for the long term, Andy?
Stocks, huh? Stocks.
For the long term. They say the ticker symbol, right? I think.
Oh, yeah. Mag 7, sir. Same. Apple, Amazon, Nvidia, Google, Meta, Tesla. I know people don't like Tesla now, but
Yeah.
it's the cycle. It's the business cycle it is going through. I'm not giving up on it yet. But yeah, Mag 7 is my preference. My risk is different, but I prefer that.
Yeah.
If you want to go
One last.
again, like I was saying earlier, you can always use JPM. And if you want to pick from industrial cat, if you want to pick from healthcare, you can pick the top lead. Any industry, go there and pick the top leader. That's it. Don't even pick the second guy. Always pick the leader in that particular sector. Is fine. Even if you go down, when it comes back, the leader comes back stronger.
Diwakar Garu, can we take one last question, Andy? Or
Sure. Yeah, last question. Yes, go
yeah,
ahead.
what are the top tickers for bond ETFs, Andy? Bond ETFs.
So bond ETFs have IEF, that is 5 to 7 years ETF. Then TLT, which is very popular. It is a 20-year bond proxy, but it is very liquid and you can get in and get out very faster also. IEF, IEH, and TLT. These are the normal ones. People trade a lot for ETFs, for bonds.
Awesome, Andy. Thanks, and over to you.
Okay, I will take it. And thank you, Jay, for answering all the questions for the audience. A very informative session and a very interesting one. And thank you, Abhishek Parsi and Jagadish Chinna for moderators asking all the questions. And thanks to Deepti Miriala for in introduction note. So Deepti, you can start now. Vote of thanks. Thank you very much. Yeah.
Yeah, thank you, Diwakar Garu. Yeah, we are excited to share that the Telangana American Telugu Association hosted a successful financial webinar. It was an insightful session packed with valuable information that can benefit everyone looking to enhance their outstanding for the economic field. Thank you, Jay Devaki Garu, for your expert insights on the financial markets outlook for 2024. We are grateful for your excellent talk on the financial market outlook for 2024. Your expertise and insights were truly invaluable to the community. And your ability to break down complex market trends into digestible insights is a rare gift. And it was a privilege for all us to benefit from your knowledge. So we are looking forward to more enlightening discussions with you in the future. And thank you for your patience for staying so long and answering all the questions. And thanks to our TTA President Vamshi Reddy Garu and Mr. Naveen Reddy Garu, President-elect, and all the AC and EC. And thanks to our General Secretary Kavita Garu, who attended the session and who made her presence throughout the webinar. And thanks to our Board of Directors, RVPs, RCs, and all the TTA members. And kudos to the moderators, Abhishek Parsi and Jagadish Chinnam, who tackled the entire session so well. And thank you for your tremendous efforts in organizing and executing the event successfully. And thank you to everyone who participated in the financial webinar today. And we also appreciate our Executive Director, Dr. Diwakar Jennam Garu, Executive Director of TTA, the TTA Boston team, and Deepika Reddy's social media team for their outstanding work and dedication. And stay tuned for more upcoming webinars and empower yourself with the knowledge and tools to make informed financial decisions. And we appreciate your efforts. And thank you for showing interest in our webinars and look forward to welcoming you to our future events as well. And thanks to one and all who joined the financial webinar and made it success. And stay tuned with our Facebook, Instagram, YouTube, and Twitter for many more upcoming events and digital conferences. And thank you, everyone.